For decades, the advice for retirement has felt pretty much the same, right? You invest in the market, you ride the waves, and you just hope for the best. But what if that conventional wisdom is based on a world that, well, doesn't really exist anymore? Today, we're going to explore a totally different way to think about building a retirement foundation, one that's designed not to crack when the market inevitably does.
You've probably heard of the 4% rule. It's been the go-to guideline for retirement planning for ages, and it sounds so simple, so safe. But here's the real question. Is it a guarantee you can actually take to the bank, or is it more of a guess based on the market conditions of yesterday? It's a question that's becoming super critical for anyone planning their retirement right now.
So, let's pull back the curtain and really break down why this supposed cornerstone of retirement planning might have some serious cracks in its foundation. We're going to look at the hidden risks that nobody really talks about.
See, the 4% rule isn't some law of nature. It's built on a whole bunch of pretty fragile assumptions. It assumes you won't get slammed with a big market drop right after you retire. It kind of just hopes that the future will look exactly like the past, that inflation stays tame, and hey, that your retirement won't last more than 30 years. In the world we live in today, every single one of those is a huge question mark.
But out of all those risks, there's one in particular that can absolutely wreck a market-dependent retirement plan, even if you do everything else right. It's this quiet but incredibly powerful threat called sequence of returns risk.
Okay, let's look at a tale of two retirees to see how this plays out. First up, meet retiree A. They start with $1 million and what do you know, they retire right into a booming market. So even though they're taking money out every year, their portfolio is actually growing because those positive returns are just crushing it. This is the dream scenario, right? They got lucky with their timing.
Now, here's retiree B. They have the exact same starting portfolio, and they're taking the exact same withdrawals, but they retire right into a nasty market downturn. Suddenly, they're forced to sell their investments at rock-bottom prices just to get the income they need to live. And even when the market finally turns around, the damage is done. Their portfolio is so depleted it never, ever catches up.
And this is the absolute kicker. The thing that decided whether they had a secure retirement or ran out of money had nothing to do with their savings habits or their planning. It was all about the random luck of market timing, something completely and totally out of their control. That is the devastating power of sequence risk.
So, how do you fight back against bad luck? Well, you build a foundation that doesn't rely on luck in the first place. And this is where a completely different strategy comes into play. One that's designed to give you a protective floor where the absolute worst thing that can happen to your money in a down market is nothing.
It's called a Fixed Indexed Annuity, or you'll hear it called an FIA. And here's the simple version. It's a contract with an insurance company. Your money isn't technically in the market, but your interest gains are linked to a market index, like the S&P 500. So you get the upside potential, but, and this is the key, your principal is completely protected from any market losses.
And here's where it gets really powerful. Let's say the market has an awful year. It just tanks, drops 20, 30%. Your account doesn't go down with it. Instead, you're credited 0%. You don't lose a dime. So while everyone else in the market is digging out of a massive hole just to get back to where they started, you start the next year from a solid, stable foundation. In this world, zero is absolutely your hero.
I know what you're thinking. How is that even possible? How can an insurance company give you market-linked gains with zero downside risk? It all comes down to some really powerful features that are built right into the modern annuity contract, and they're designed specifically to do one thing: create a guaranteed income you can never outlive.
The secret sauce is something called an income rider. Think of it like this. The insurance company sets up this separate, protected value that's only used to calculate your future income. Then, this special value grows at a guaranteed rate, let's say 7%, every single year, no matter what the market does. So when you're ready to retire, your lifetime paycheck is based on this much larger, protected amount. It's a way to guarantee your future income grows, even when the market is going sideways or down.
And on top of that guaranteed growth, a lot of these FIAs give you an immediate bonus from day one. So, if you put in, say, $400,000, a 20% bonus means the value that's used to calculate your future income starts at $480,000 instantly. That is a massive head start on building that guaranteed income stream for life.
All right, all of this sounds pretty good in theory, but how does it actually stack up against a traditional all-in-the-market portfolio? Well, let's put them head-to-head in a 10-year showdown during a really volatile stretch of time and see what happens.
Okay, before we dive into the numbers, you got to understand the fundamental difference in philosophy here. On one side with the FIA, you have a strategy that's built on a foundation of contractual guarantees. We're talking principal protection, a guaranteed growth rate for your income, a predictable paycheck. On the other side, the market portfolio is all about potential, and with that potential comes the chance for big gains, but also the very real risk of huge losses.
And here are the results. Just watch what happens in those down years. In year 3, the market gets absolutely crushed, losing 38%. The market portfolio just plummets. The FIA, it gets that hero zero and holds its ground. Same thing happens again in year 6. Now, fast forward to the end of this roller coaster decade, you can see that even with some pretty good market years mixed in, the FIA's simple ability to not lose money results in a way better outcome. That's the power of steady growth without those devastating setbacks.
Now, I want to be really clear about something. This does not mean you should just abandon the stock market entirely. Not at all. The real key here is to use the right tool for the right job, and the job we're talking about is creating a secure, guaranteed foundation for all your essential income needs.
An FIA is a fantastic tool, but it's definitely not a one-size-fits-all solution. It tends to be the best fit for people who are getting closer to retirement, that 50 to 65 age range, people who absolutely cannot afford a major loss and really need to create a reliable pension-like income stream. For younger investors who have decades to recover from a downturn, or for someone who needs immediate access to every penny, a different strategy probably makes more sense.
So here's the bottom line. Think of an FIA not as a replacement for your market investments, but as a shock absorber for your retirement. It's that foundational piece that handles your mortgage, your groceries, your essential bills with guaranteed income. And that frees up your other assets to be invested for long-term growth without you having to lie awake at night worrying that a market crash is going to derail your entire life.
And that really just leads us to our final thought for you to take away today. In a world that seems more and more uncertain, what does a truly crack-proof retirement foundation look like to you?
The insights for this explainer were drawn from the work of Stephen Jeung, founder of the Jeung Agency. We hope this breakdown helps you